Greetings, everybody. Welcome to Liberty Call. Today is Thursday, April 13th, 2023. Hope everybody's having a fantastic day out there in the interwebs. Pretty good day in the markets. I guess the producer prices index came in and made everyone feel really good. So lots of green today. It didn't fall apart like it did yesterday afternoon. But again, tomorrow's another day, so we shall see what happens there. So if it's your first time watching Liberty Call, please give me some thumbs up, likes, shares, subscribes. I'd greatly appreciate it. And let's go ahead and jump into the numbers for today. The Dow Jones was up, 1.14%, 383 points, closed at 34,029. S&P 500 is up 1.33, closed at 4146. NASDAQ up 1.99, closed at 12,166. The VIX fell 6.76%. It's currently at 17.8. Canada was up 0.54. Brazil down 0.44. Mexico was up 0.67. Over in Europe, Germany was up 0.16. UK up 0.24. France up 1.13. Netherlands up 0.14. Spain up 0.34. Italy down flat 0.01. Let's see here. Switzerland up 0.24 and Portugal up 0.25%. Russian exchanges both green, MOEX up 0.23, RTSI up 0.77. And the overnights in Asia, a little more mixed. The Nikkei in Japan was up 0.26, Australia was down 0.27, New Zealand up 0.05. In the Chinese markets, the Shanghai was down 0.27, the Shenzhen Component down 1.21, China A50 up 0.19, DJ Shanghai down 0.3, Hang Seng up 0.17, and the Taiwan weighted was down 0.69%. So it looks like most of the good news from that inflation report came in, and I'm not sure if they got it early enough in Europe for that to make a difference in their trading, but definitely was a big lift for us here today domestically. All right, well, let's go ahead and jump on over to today's market recap. S&P 500 rides tech rally higher as Treasury yields stutter on easing inflation. All right, where'd my notes go? Here we are. The S&P 500 was up by 1.3% on Thursday, April 13th, as big tech stocks climbed, while Treasury yields stumbled on data revealing on a cooling inflation rate and easing labor market tightness. The Dow Jones Industrial Average added about 1% or 350 points, and the NASDAQ was up about 2%. Tech companies such as Alphabet and Apple led the gains, with the former rising by 2% and the latter by 3%. This upward trend was mainly driven by a fall in Treasury yields, which was a result of data showing that wholesale inflation had cooled more than anticipated. The producer price index for final demand declined by 0.5% in the previous month compared to the anticipated 0.1% increase. In addition, the PPI rose 2.7% in 12 months through November, well above the 3% forecast. Let's see here. Apart from a decrease in inflation, why did it say November? I'm not sure. I'd have to go back and read it. Apart from a decrease in inflation, there were indications that the tight labor market could support less aggressive monetary policy from the Federal Reserve. The minutes from the Fed's March meeting revealed that the central bank anticipates that the recent banking turmoil will lead to a mild recession later in the year, mild recessions in quotes. Moreover, the U.S. Department of Labor reported that initial jobless claims increased by 11,000 to 239,000 in the week ending April 8th, compared with expectations of a 4,000 person increase. Delta Airlines saw a 1% decline after reporting worse than expected quarterly results. However, the company predicted record advance bookings for the crucial summer period, which boosted other airlines such as United Airlines Holdings and American Airlines Group, each of which saw gains of over 1%. Energy was slightly above the flat line, but concerns about a possible U.S. recession causing a decrease in energy demand weighed down on the sector. Netflix saw a 4% increase after Wells Fargo released a bullish outlook on the stock, predicting that the streaming giant will likely benefit from the rollout of its paid sharing program. Financial stocks also contributed to the broader market climb as bank stocks gained ahead of the quarterly earnings season, which begins on Friday. JP Morgan Chase & Co., Citigroup, and Wells Fargo are set to report quarterly results before the opening bell on Wednesday. Wedbush stated that they expect deposit flows to be the center of attention following the banking sector's turmoil over the past month. They also predict that loan growth will slow due to uncertain economic environment and higher rates, which could impact demand. All right, so that was everything in there. So let's move on over to a little more detail on the labor market. U.S. labor market gradually losing steam. Producer inflation is cooling. All right. The number of Americans filing for new claims for unemployment benefits increased last week by 11,000, according to the Labor Department. The total reached 239,000 for the week ending April 8th, surpassing economists' expectations of 232,000. The rise in joblessness suggested that the country's labor market was beginning to ease due to increasing borrowing costs, depressing demand in the economy. While the figures indicated that the economy's momentum was slowing, they also revealed that the labor market and inflation are likely not cooling fast enough to prevent the Federal Reserve from raising interest rates one more time in May. The week's claims also report showed that the number of people receiving benefits after an initial week of aid, a proxy for hiring, dropped 13,000 to 1.81 million during the week ending April 1st, not too far from pre-pandemic levels or record low levels. Meanwhile, job openings fell below 10 million at the end of February for the first time in nearly 2 years, but there were 1.7 vacancies for every unemployed person that month, which could make it easier for some laid-off workers to find employment. Financial markets suggest that the Fed will raise rates by another 25 basis points at its May 2-3 meeting, which will likely be the last rate hike in the central bank's monetary policy tightening campaign since the late 1980s. Well, we shall see. I mean, these financial journalists have been saying over and over again that they hope that rates are going to be cut sooner than later. They've been saying that really for about a year. I mean, when they first started this tightening cycle. So we shall see. In March, the Fed raised its benchmark overnight rate by 0.25 percentage point, but indicated that it was on the verge of halting further rate increases in recognition of financial market turmoil. The Labor Department also revealed its producer price index for final demand dropped by 0.5% in March, the largest decline since April of 2020, following February's lack of change. Gasoline prices fell 11.7% last month, while food prices increased 0.6%. Prices for services fell by 0.3%, the largest decline since April of 2020. Transportation and warehousing services saw costs fall by 1.3%. All right, so some good news. Things are slightly slowing down, but as far as I was reading an article earlier, I guess it was an email earlier today, and they were talking about the CPI data and how everybody seems to be cheering themselves. But the person I was reading referenced this website called Truflation, which is this company's methodology on determining what the true inflation rate is at any given time. So if you look back here, last summer, they estimated the inflation rate was, between 11 and 12%. The CPI never got up that high. So, and what he pointed out here was on this chart, it looks like we've had a bounce from, looks like March 26th, and the inflation rate has been climbing ever since then. So his estimation was that we would see some sort of a bounce in inflation. No telling how high it's going to go, but again, something to keep track of, something I'm going to pay attention to over the next few months and see how this trends right here with the CPI numbers that are coming out from the government. All right. Last article here. It's titled Peak EV, Electronic Vehicles Will Fade as Their True Costs Become Clear. Anyone who listens to me on a regular basis knows I'm not a fan of electric cars. I think they're garbage. They're too heavy. If there's accidents and they catch on fire, they're a pain to put out. If you have to change out the battery, which usually about every 7 to 10 years, from what I understand, is going to cost you an arm and a leg. And, until they get the size of the cells down to something smaller where it's not adding so much extra weight to the vehicles and all those other problems, I just don't see it being a realistic solution. But we shall see. All right, let me bring up my notes. The EPA is expected to announce a new tailpipe emission standard aimed at phasing out gas-powered cars, according to The Verge. However, investor Harris Cooperman believes the push towards environmental, social, and corporate governance, or ESG, is nearing its peak and compares it to a religion that has peaked and is dying out. Cooperman argues that the electric vehicles will also go the way of the Roman gods and the T-Rex, citing the energy return on investment that makes EVs energy intensive and ultimately less carbon efficient than gas guzzlers. Furthermore, Cooperman believes that the lifetime cost of owning EVs is astronomically high, particularly as battery degradation sets in and batteries need replacing. And without government subsidies, consumers will likely continue to purchase internal combustion engines. Kupperman also views ESG as a tax on humanity that is detrimental to those wanting a better standard of living. He believes that the continued demand for energy is unstoppable and that the government's attempts to address the energy crisis will likely make things worse, including trying excess profit taxes, export bans, and price caps. The net result is that energy companies will likely take their dividends and go to the beach rather than drill for oil. Overall, Kupperman predicts that the energy crisis is on the way, courtesy of the government's interference in the energy industry. All right. So, and all these articles are linked in the show notes. If you want to go and read the long version, you're welcome to do so. That's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.